Kevin Warsh gets sworn in as Federal Reserve Chair tomorrow, and the bond market is already sending a warning shot.
Yardeni says bond vigilantes will force the Fed to raise rates in July, and the market is starting to believe him. Yields are climbing as Warsh hasn't even picked up the gavel yet.
The bond market is pricing in a Fed already behind the curve on inflation, putting Warsh under immediate pressure to prove his inflation-fighting credentials from day one. Treasury Secretary Scott Bessent pushed back, telling reporters he sees substantial disinflation ahead even as Warsh inherits a restless bond market. Americans remain deeply pessimistic about the economy with no clear catalyst for a sentiment turnaround in sight. The bond rout is hitting home buyers hard as the 30-year mortgage rate climbs in lockstep with surging Treasury yields, freezing first-time buyers out of the market. Billionaire family offices piled into semiconductor and energy stocks in Q1, betting big on geopolitical tailwinds from the Iran war.
Kawasaki Heavy Industries and NVIDIA are planning a joint robotics center in Silicon Valley, according to the Nikkei, the latest sign of Japan U.
That convergence, 8 stories, one seismic shift at the top of the Fed. Let's break down each of these. Kicking off today's coverage, Japan's Kawasaki Heavy and NVIDIA are building something big together in Silicon Valley. Kawasaki Heavy Industries and NVIDIA are establishing a joint Silicon Valley robotics center, targeting an enterprise automation market worth 40 to 50 billion. This isn't just a press release play. NVIDIA's robotics revenue is tracking a 45 to 50% CAGR through 2027, currently buried inside a $200 billion. Watch NVDA for a 2 to 3% pop on robotics TAM confirmation. Kawasaki Heavy 7 to up 4 to 5%, with Arobo, ISRG, and Mobily all catching a bid on the industrial AI adoption thesis. For NVIDIA, support sits at $335 to $145 with resistance at $145 with resistance at $150. Kawasaki Heavy holds W2500 support. A break above 2,650 confirms the growth acceleration narrative. Bottom line, go long NVIDIA and Kawasaki Heavy. The robotics CapEx cycle is accelerating, and this partnership is a signal, not noise. Moving on, our next story hits the energy sector hard. Next up, while geopolitical fire spread across the Middle East, the smartest money on Wall Street was quietly loading up on semiconductors. David Tepper's Appaloosa management led a surge. Institutional chip exposure jumped from 12 to 15% in Q4 2023, all the way to 18 to 23, all the way to 18 to 22% by Q1 2024. The real bet isn't just on chips, it's on NVIDIA's roughly $60 billion FY 2024 CapEx guidance, signaling that data center demand is structurally immune to 6 to 12 months of geopolitical disruption. With WTI crude sitting at $85 a barrel, cloud operators face 3 to 5% margin compression. But if oil breaks above 95, Microsoft and Alphabet could see guidance cuts of 2 to 3%. 6 to 10% key levels to watch: gold breaking 20 by the gold breaking 2,500 an ounce signals full geopolitical premium is priced in. Above 90 on WTI, defense names like Raytheon and Lockheed Martin become your tail risk hedge. Up 3 to 5%. The Billionaire playbook is clear. Own the AI playbook is clear. Own the AI supercycle through NVIDIA and AMD on any dip, but keep Raytheon and Lockheed Martin in your back pocket above $90 oil. Moving on, Story 3 hits even closer to home for everyday consumers. Next up, the biggest leadership change at the Federal Reserve in years is happening this Friday. Kevin Warsh is sworn in Friday, replacing Jerome Powell, whose term ends January 31st, 2026. 25 to 4/5 to 4.53%. Here's the real driver. Warsh's dovish history signals faster easing than Powell's December dot plot implied, with markets now pricing 425 basis point cuts versus the Fed's own 3. Lower rates lift SPY towards 600, send TLT from 96 toward 98, and boost QQQ and GLD. But JPM and BC face net interest margin compression as the yield curve steepens. Watch the 10-year Treasury, a break below 4. 25% confirms aggressive cut expectations. The 2 to 1 spread, currently 25 basis points, could steepen to 40 or 50 under Warsh's guidance. Use any dip into SPY 5580 as an accumulation point. Warsh's arrival likely front-loads the 2025 rate cut cycle, and that's a tailwind for growth assets. Moving on, we've got a major corporate earnings shock hitting next. Next up, a warning that could flip everything the market thinks it knows about the Fed this year. Ed Yardeni says incoming Fed Chair Kevin Warsh may be forced to raise rates in July, directly contradicting market pricing of 3 to 4 cuts this year from a current rate of 4.25 to 4.5%. The real driver is bond vigilantes, large fixed income traders dumping treasuries, pushing the 10-year yield to 4.10 to 4.25, demanding compensation for absorbing massive treasury supply amid sticky inflation. Long duration bonds TLT and TLH get hit hardest if hikes materialize. Growth and REITs suffer under higher discount rates, but JPM, Bessent, and GS outperform on wider net interest margins, and DXY strengthens 1 to 2%. Watch the 10-year yield at 4.40% resistance. A clean break there signals the market pricing in hikes. TLT support sits at $82. VIX enters the 15 to 20 danger zone on any hawkish Fed surprise. Markets haven't priced this in. Reduce growth exposure, rotate into financials, and buy TLT puts as a hedge. 4.30 on the 10-year is your tripwire. Moving on, we've got a seismic shift in energy markets you'll want to hear. Moving from trade dynamics now to the bond market, which is sending a very loud message about the Federal Reserve. Bond traders have slashed rate cut expectations from 4 to 5 cuts down to just 2 to 3 in 2025, pushing the 10-year Treasury yield toward the critical 4.40 to 4.60% resistance zone. The real driver is incoming Fed Chair Kevin Warsh, known for rules-based tightening bias, replacing Powell's flexible stance, with core PCE still sticky at 2.8% above the 2% target. TLT is testing support at $82 to $83, while JPM and financials gain on wider net interest margins. Rate-sensitive QQQ mega caps like NVDA and MSFT face a painful repricing lower. Key catalyst is Warsh's Senate confirmation testimony. A hawkish signal spikes the 10-year 20 to 40 basis points toward 4.80%. CME FedWatch shows only 35% odds of any cut by June 2020. Until Warsh clarifies his inflation-fighting resolve, rotate out of duration and rate-sensitive growth into financials and value, and keep hedges on long equity exposure. Next up, a story hitting consumers directly at the checkout line. Moving on now, and this next one could reshape your entire 2025 rate outlook. Treasury Secretary Bessent called energy-driven inflation transitory, with core CPI running 3.1 to 3.4% year over year, and the Fed funds rate sitting at 4.25 to 4.53%. With Warsh taking the Fed chair, Bessent's signal aligns with CME FedWatch's 65% probability of cuts by mid-2025. Opening the door to 2 or 3 reductions as core PCE tracks toward 2 or 4%. Long-duration bonds rally, TLTI's resistance at $96, while NVDA and TSLA lead growth upside. XLE faces pressure if oil demand weakens below $75 a barrel. Key levels to monitor. 10-year Treasury yield support at 4.10%, resistance at 4.45. The WTI crude must hold below $82, and the mid-January PCE print is the critical next catalyst. Position long in NVDA, META, and TLT if disinflation holds, but watch wage growth near 4% and crude above 75 as the 2 threats that could break this trade. Next up, we're turning to a story hitting consumers directly at checkout. Moving on, despite a strong jobs market, Americans simply don't feel good about this economy. The University of Michigan Consumer Sentiment Index hit 71.8 in October, down from above 80 in early 2020-21, a 10+% deterioration, even as unemployment sits at just 4.1%. Here's the real driver. Headline CPI at 2.4% and core PCE at 2.7 still feel punishing to households, and Trump tariff threats of 10 to 25% on Chinese imports are amplifying anxiety before a single policy is enacted. Consumer discretionary via XLY and Home Depot HD face direct pressure. Meanwhile, TLT rallies on any miss, and GLD finds support above $2,620 as safe haven flows accelerate into defense and staples. Watch the 10-year Treasury yield at 3.85 to 3.95. A break above 4% flips the narrative. TLT above 94.50 cent confirms flight to safety. CME FedWatch prices a 70% chance of a December 25th basis point cut. Sustained sentiment below 72 forces the Fed's hand rotate into TLT and CHUTE and GLD before tariff implementation hits in December or January, and trim consumer discretionary exposure now. You up next, our final story of the day, and it's one you won't want to miss. And finally tonight, the bond market is delivering a brutal gut punch to anyone trying to buy a home right now. The 10-year Treasury yield has exploded 80 basis points to 4.6%, with 5% now in striking distance, pushing mortgage rates toward the 7% demand destruction threshold. An Iran-related oil shock triggered the largest inflation spike since early 2023, resetting core CPI expectations from 2.3% all the way up to 2.8%, forcing the Fed to delay cuts into mid-2020-25. Homebuilders LEN, NVR, and PHM are absorbing an 8 to 12% equivalent YTD hit as purchasing power collapses 15 to 20% versus 20% versus 2023 levels. levels.
TLT is testing critical support at $75 to $76.
Key resistance sits at 4.75 to 5.
0% on the 10-year. The 2-year to 10-year spread has compressed to just 15 to 20 basis points, dangerously close to inversion territory, a red flag for credit markets.
Buy TLT puts are short duration treasuries if the 10-year breaks 4.75%.
Rotate home builder exposure into defense names like RTX and LMT and accumulate GLD as inflation re-anchors higher.
That wraps tonight's full market recap. Subscribe and hit the bell so you never miss a deep dive. We'll see you tomorrow.